Welcome back. You're watching HFO-TV.
Please join me in welcoming Michael, and he's going to give a little update on this tax bill. Thank you.
And now for some good news. All right, so in your packets there, in your HFO folders, there is a handout here with a really pretty guy in the corner. But what's more relevant for you, and this might be useful in following along, is toward the top, on the left-hand side, it says Tax Reform Bill Highlights for Real Estate Owners. There's 10 points, and we're not going to talk about all of them in the interest of time. But we'll probably talk about the first 5 or so. And certainly, I'm very open and willing to get questions. You feel free to call me, send me an email. Happy to talk to you about these things. You know, this tax reform bill has certainly changed the months of December and January for our firm at Geffen. Those months are normally a little bit slow, and it's been nothing but slow. My challenge today is that I'm going to talk to you about a topic which I'm going to speak about next week for an hour and a half. And we're going to do that in less than 15 minutes. So bear with me. I'm going to go somewhat quickly, but I think you'll still find the information useful. On balance, this tax bill had positives and negatives. And certainly there will be winners and losers. I think the real estate industry fared better than nearly any other industry. And we're going to talk a little bit about why that is. One of the ways that won is some of the things that didn't change. I think you all know probably that 1031 exchanges still exist for real estate. That's a huge win for the industry. Now, there are some other provisions here that are wins, and there are some that will be some challenges. So let's walk through some of those real quick. And you can see, if you have that list in front of you, that number 1 is the change in the individual tax rates. So we went from a top tax rate for individuals at 39.6% down to 37%. John already touched on the change in the corporate rate, which is down all the way to 21%. But most real estate, at least the clients I work with, most of the time that tax is paid by individuals. The real estate is owned in partnerships, LLCs, and at the end of the day, it's individual taxpayers who are paying that tax. So the first piece of good news is simply that drop in the individual tax rates, as well as when that top rate takes effect. So that 37% rate for a married couple, that doesn't kick in until income over $600,000. So pretty significant changes there. But the clincher is the next piece, this 20% deduction on non-corporate qualified business income. Now, frankly, this is one of the most complicated parts of the law. Last Saturday, I don't know about you, but I like to spend my Saturday nights reading tax articles. So I was sitting on my couch. I got to admit it, the in-laws were over, so it was a good time to do it. But you know, still, I had important reading to do. I read a 35-page article on nothing but how this 20% deduction works. It is not simple. My clients keep calling me saying, "Hey, Michael, I'm going to get this deduction, right?" And of course, you know how your accountant responds. They always say, "It depends." Well, in this case, it really depends. But we're going to just talk about it briefly, because if your real estate income, and this is going to apply to most rental income, if this 20% deduction applies, then what that means is you might be paying a 37% top rate on just 80% of your income. Or put another way, that's an effective tax rate of 29.6. And remember, we were just at 39.6 at the top. So that's a 10-point reduction. That's huge. That can significantly increase after-tax returns. So let's talk about this 20% deduction just a little bit. It's pretty simple until incomes exceed a certain level, and then it gets much more complicated. Bottom line, though, is that this deduction is available for individuals, whether the income is coming from a partnership, from an S corporation, perhaps rentals that they just own directly, personally, and report on a Schedule E on their personal tax returns. This deduction is potentially available on that type of income. It's not available for C corporations. They already got their big tax cut. This is for the individuals. It also applies to trusts. So, if a married couple's income is under $315,000, or if a single person's income is under $157,000, then they're going to qualify for this 20% deduction quite easily. Is it business income? Yes, it is. Then you get 20% deduction. Very simple. Doesn't apply to wages, okay? So if I'm an employee and I have wage income, I don't get a 20% deduction on the wage income, but I do get it on my business income, the rentals that I own, perhaps my self-employment income. The issue is, what if my income is above that threshold? Do I still get the deduction? And that's where we have a lot of complex rules. The answer is, if my income is over that threshold, again, the threshold is $315,000 for a married couple, then whether I get that deduction or not is going to depend on what source is the income from and some other aspects about that business activity. So first, the source. There are certain people that Congress did not want to get this benefit if they made too much money, apparently. Ladies and gentlemen, I as an accountant am part of that bad list. Can you believe it? Nice people like me don't get this deduction. Neither do doctors or lawyers, investment managers, consultants. There's a whole laundry list. Now, there is another part of that definition that's kind of scary. It also says it doesn't apply to business income if the primary asset of the business is the reputation or skill of specific people, including owners, working in the business. Well, that could be applied broadly, or it could be applied narrowly. We'll have to wait for regulations to find out. But one thing we do know is that this deduction should apply to rental income. Now, if you also have a management company and you've got management fee income, will it apply? Well, I think so. But we're going to need some regulations to really flesh out these categories that don't qualify. But rental income should absolutely qualify. So let's talk a little bit about that. Rental income qualifies. Are you going to get the 20% deduction? Your total income is over the threshold. Well, it depends. And what does it depend on? Well, you have to jump over one of two hurdles. Either your deduction is limited by 50% of the wages to your employees. Well, hold on. A lot of the tax returns I prepare for rentals don't have any employees on them, right? A lot of our rental entities don't employ people. Okay, so we're not going to jump over that hurdle. Boy, I sure hope there's another one. Well, it was a late addition, and this is one of the ways the real estate industry won. The other hurdle is it's limited by 25% of the employee wages, who cares, plus 2.5% of the basis of your depreciable property. All right. So I have an apartment complex, and I'm depreciating the building, and the basis in that building is $10 million. All right, so what's 2.5% of $10 million? $250,000? All right, that tells me that my deduction can't exceed $250,000. If I had $1 million of income from that complex, 20% deduction is $200,000. The 200 does not exceed the 250 limitation, and voila, I get my $200,000 deduction, and now I'm paying a 37% tax rate on only $800,000 of income instead of the full million. See how that works? I know this is a lot of numbers. That, in essence, is how this is going to work for folks that have rental income. I think by and large, it's going to be very helpful, and most of the time, you'll get a significant deduction. Of course, you could have almost no basis in your rental properties. Maybe you've owned them for 30 plus years and you've depreciated them down to nearly nothing. Maybe you always do 1031 exchanges, and so you have low basis in this property and it rolls into low basis in another property. Well, 2.5% of that low basis might be a pretty small number, and so your deduction might be limited quite a bit. Okay, so when a client calls and says, Michael, just quick question, am I going to get the 20% deduction? That's why we say it depends. So, will this create more work for us? Yes. Are we happy about that? Yes, but we'd rather have the 20% deduction, but we're bad people, so, feel sorry for us. That is, in a nutshell, that provision, one of the most complex and significant provisions for the folks in this room. I'd be remiss, though, if I didn't also mention the bonus depreciation rule change. John touched on that briefly. This is a big deal. Essentially, after November 27th of last year, and through the end of 2022, we get 100% bonus depreciation on our qualified fixed asset additions. What this basically means is any interior improvements that you're going to be making to these properties are going to be 100% deductible immediately. I can think of very, very few exceptions to that. After 2022, this thing starts to taper, goes to 80%, 60%, 40%, etc. So this is going to be around for a while. If any of you are familiar with Section 179, which is another depreciation code section, that also got expanded. Not everybody qualifies to take that, but for those that do, one of the expansions in that code section was that now you can use that to deduct a new roof. 100% of that. And I'm not talking about a new layer of shingles. We could already deduct that. I'm talking about a tear-off. So, pretty significant enhancements on the depreciation side with respect to fixed assets and improvements. Now, I do also want to touch briefly on the fact, as John mentioned, that we have an interest expense deduction limitation. And frankly, I think this is going to be a big deal a few years down the road and less of a big deal right now. And here's the reason. Again, they don't make things easy. So the way this works is they've said that deducting interest, well, your deduction is limited to 30% of your adjusted taxable income. Well, what's adjusted taxable income, Michael? Good question. It depends on what year you're asking. So right now, adjusted taxable income is what we would call EBITDA. So it's earnings before interest, taxes, depreciation, and amortization. And for folks in the real estate industry, that number is normally pretty high because we take a lot of depreciation expense, don't we? And if we get to add that back, all of a sudden the income looks pretty good. EBITDA looks pretty good. So 30% of that number, maybe we don't have a problem deducting our interest expense unless we're really highly leveraged. But after 2021, so beginning in 2022, we don't look at EBITDA anymore. We look at EBIT, which is just earnings before interest and taxes. All of a sudden, we don't get to add back depreciation expense. All of a sudden, our adjusted taxable income looks a lot lower than it used to. And now, 30% of that much lower number could mean that we don't get to deduct all of our interest expense, depending on how leveraged we are. Of course, Congress likes us, so they gave us an option. We can elect to have these rules not apply to us. We can say, hey, we're real estate people. We're not everybody else. We get to make an election, and we can deduct all of our interest expense, and that's true. We have that ability, but we give something up. And what we give up is accelerated depreciation. We have to start using what we call ADS lives. Not a huge deal for some of you. So instead of depreciating an apartment complex over 27 and a half years, now we would have to depreciate it over 30 years. Not that big a deal. The bigger deal, though, is that a lot of those interior improvements I mentioned that are going to qualify for bonus depreciation, well, some of those, instead of having a normal shorter life, would now have a 20-year life for depreciation purposes. And we would lose the ability to take bonus depreciation on them and get an immediate write-off. So, again, I don't expect that to affect many of you in the short term. I expect it to affect many more of you beginning in 2022, and you'll have some time to work with your tax advisors to figure out what should I do at that point? What election should I make? The other items on this sheet I think are interesting, but I'm not going to go into them in any detail. I would just mention, though, that if you do have concerns from a federal estate tax standpoint, if you've done planning in that area in the past, we now have more tools in the toolbox. We now have a much higher exemption for estate tax purposes at the federal level. That was doubled, and so it might be time to talk to your estate tax advisor as well. In the interest of time, I will end my presentation, and again, I do look forward to your questions. Thank you.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.